we might be moving from bigger is better to, the smarter is better kind of world. And, this is where business will finally see the real win.
If you look behind the scenes, a company like NVIDIA also accelerating slightly, up to 62% revenue growth. So what this tells me is that there's a major push here.
We've seen pullbacks like this many times over the last several years. And generally when these things sort of end, we have some basing action and then these stocks come roaring back to life.
Markets, business, technology, investing, insights. AlphaTarget Pulse. AlphaTarget Pulse is a production of AlphaTarget Limited, a company registered in Jersey Channel Islands. The opinions expressed in this podcast and the information provided are for informational and educational purposes only, and are not to be construed as investment advice. You should consult with your own registered investment advisor or other qualified financial professional before making any investment decisions.
Welcome back to AlphaTarget Pulse, your podcast for insights on markets, business, technology, and investing. In today's pod, we will cover the Q3 earnings season, go over some interesting stuff which is happening in the different industries that we are watching, and also give you our high-level overview of what the earnings are like for the hyperscalers, for the big tech software, and some of the consumer discretionary space that we are watching to see the health of the economy. So let's kick off by having a look at what the stock market has done over the past couple of weeks since the last episode. Well, we've had a pullback in equities in the US over the past couple of weeks. We've had a bit of a rally over the last few days. The indices came under some pressure, but we've also seen a big pullback in AI-related companies. We've seen a big sell-off in growth stocks. And generally, these things don't happen too often. Generally, the broad market tends to move with the, or the growth stocks tend to move with the broad market. But sometimes when there is a growth scare or, when some worry basically takes over the market, then investors generally tend to sell growth stocks because they worry that the economy is going to slow down and the valuations are rich. So let's just, run and go into some other safer sectors. So we've seen some sort of rotation in equities over the last 2-3 weeks, which has hurt our portfolio because we are invested in disruptive growth stocks. But so far, we don't think this is anything alarming. We've seen pullbacks like this many times over the last several years. And generally, when these things sort of end, we have some basing action and then these stocks come roaring back to life. We think that still this is going to play out. We don't think that the US economy is sliding imminently into a recession. We have seen some weakness in October in the jobs market by the number which was reported. And because of the government shutdown, which has just ended, there was not much data coming in, and investors were pretty skittish and jittery about how to position themselves. And that's why we've seen, in our view, a big pullback in the growth stocks, plus Michael Burry took some big positions, short positions in the AI trade, and there was worry that there was some froth there. So some of these stocks have been absolutely punished hard over the last 2 or 3 weeks. We don't think this is the end of this boom. We do think that eventually these stocks will come up. And in terms of where we are in the actual AI cycle itself, we still think that this is still very, very early innings for AI, especially for inference. The return on investment on AI is going to come from inference, not from pre-training and training. And if you look at the numbers which have been forecast or projected by Bloomberg Intelligence or some of the other well-known entities, they are projecting huge growth in AI inference workloads over the next 8 to 10 years. And our view also is that inference is going to basically explode over the next 8, 10, 15 years. We are still very early in this trade or in this secular shift in how consumers and how people in general and businesses operate. So we think that this pullback is going to pretty much end, and then we are going to see another rally. Some of the things that we are watching, obviously, is the Fed. The Fed is scheduled to meet again in, I think it's on the 9th or the 10th of December. The market is basically pricing in a rate cut and also further cuts in 2026 next year. The Fed has already signaled that they're going to cut or stop the QT, quantitative tightening, which has been going on for a number of years. It's going to stop. And that will actually add to liquidity in the system because QT is basically the shrinking of the balance sheet, which reduces liquidity. If they stop that and if the balance sheet basically becomes flat and stops going down, that means liquidity pressures will actually improve in the system. And that generally has been good for stocks and risk assets. So we think that the monetary backdrop is now favorable for equities. And we saw the first rate cut not so long ago. And history has shown that if the US economy avoids a recession with the rate cuts beginning, then on average, the S&P has historically rallied by about 15 or 16% over the following 12 months. So we still think that this pullback is temporary. It has been a big drawdown, no doubt about it. But, if you invest in equities, you have to be mentally ready and prepared for volatility. There is no such thing as a free lunch. If you want, a 20%, 25% annualized return without any swings, then I'm afraid you're not going to find that. You can get a 5% return in, bonds, but you're not going to get more than that. That's not going to be volatile, but you're not going to make big returns. So if you want big returns, then, the name of the game is to be able to stomach the volatility occasionally. And that's unfortunately a drawdown we've experienced now, but I think this will pass. It always does. So our outlook is that we think that this chop is largely over. The trend has flipped to up again recently. That's why we removed the portfolio hedge. We think that equities will probably rally into December because of the holiday season, the traditional Santa Claus rally, and a lot will depend also on what the Fed does and what the guidance is. But for now, I think the trend is still up, and we are positioned for the rebound in these AI-related stocks and also the growth stocks. We feel that our portfolio is positioned properly in AI-related companies, in software companies, e-commerce companies, payments companies, and so forth, which we feel, and also autonomous driving companies. So we feel that our portfolio is positioned properly in the leading businesses in these areas, and when the market sentiment improves, these stocks should come back to life. With having said all of this now, let's bring in our team for our discussion. First and foremost, Ernest, our numbers man, CFA charter holder, top-ranked analyst in South Africa for a number of years, and former analyst at SocGen, Societe Generale. Next is Anirban, Mr. Bleeding Edge, PhD in computer science and former director of research and portfolio manager at the Motley Fool in Australia. Damia, our data queen, former analyst who previously worked at Citibank, and she also worked at a number of investment banks and brokers in Malaysia. And finally, Avin, our big picture thematic guy who previously worked at Peel Hunt, Berenberg, and ASIO Family Office. So let's just discuss the Q3 earnings season, which is now largely behind us, and get our analyst takes on what they, have been watching and what they think about the overall trends and, some of the key areas that we are monitoring. Ernest, I'll start off with you. If you can please just share your thoughts on, the numbers which were put out by the hyperscalers, by these big tech companies. What do you think is going on there? And are you generally satisfied with the numbers or not?
Thanks, Puru. For me, it was really a good Q3 in the big tech space. I think the thing I'm watching there is each of the big tech players has got a fairly sizable cloud business. And that's the area which I'm focused on. It was very good. We saw Amazon's AWS accelerating from like 17 to 20% growth. I mean, that's a over $120 billion run rate. So that's fantastic. We see a company like Microsoft with their Azure growing very strongly, 39% maintained. And then you've got Google's GCP, accelerating from 32 to 34%. Now, these are really amazing numbers for run rate businesses close to $100 billion. And then, if you look behind the scenes, a company like NVIDIA also accelerating slightly, up to 62% revenue growth. So what this tells me is that there's a major push here. We're seeing the AI driving a lot of interest. There's a lot of clients clamoring to get in there and move their workloads into the cloud. But the point I wanted to make is just remember, with all this AI hype, there's also the underlying secular shift of normal workloads going to the cloud. And we're only about halfway through on that. So that's got a long way to go. And then we're overlaying all the AI. Yes, the CapEx is very high, but it's very comforting knowing that the operating cash flows are more than comfortable. They're more than comfortably paying for the CapEx. So I'd say all these three are in good shape, the big three, and looks like it's set to continue for the next couple of quarters.
Great. I'll come over to you next, Anirban. You've been watching the consumer discretionary space, some of the restaurant earnings, some of the footwear earnings. Can you please share your thoughts on what you're seeing over there?
Thanks, Peru. So unlike, big tech, which actually looked like really good results, I think we can't say the same about the consumer discretionary or, if you think of things like Lululemon, Kava, it's a restaurant chain, growing restaurant chain, Chipotle Mexican Grill, Decus, which has, the famous brand Hoka and Ugg boots. I mean, all of them, what I saw is same store sales basically are very sluggish, especially when you look at the Americas section. And that basically points to what you just said in the news section was, the unemployment is going up. I think the general consumer sentiment seems to be that, kind of not going to spend as much as I was spending last year. And I think we see that in all the results. So yes, there's a lot of sluggishness in the economy, which, points to the fact that, rates are still high and, inflation is still probably high enough that it is hurting the consumer and, forcing them to make choices.
So I'm going to go to Damia next. Damia, you've been watching the software space pretty closely and keeping an eye on all the numbers coming out. Can you please share your thoughts on what you're seeing there in the software space? Any positives, any catalysts that you're actually watching?
Of course, Puru. Yeah. So for the software space, we're seeing enterprise software companies, especially revenues accelerating. They are generally already delivering like durable revenue growth, even without implementation of any AI before this. But now with new products coming out, with AI related products, and of course implementing AI in their operations, we are definitely seeing a creative revenue contribution. They are already starting to monetize from the AI related products, which leads to revenue acceleration. We are also seeing operating leverage improving, so that's good for their bottom line margins. And even with the continued growth, there are still some good software companies which are still at good valuations, so which we already invested in. And those which are pricey, for example, like Palantir and Cloudflare, we've already taken profit from those, so we're no longer invested in them. But we are still invested in some of the companies which have some more growth in the pipeline. So yeah.
Yes, Damia, we have seen some reacceleration in the infrastructure software space. Palantir has done incredibly well, but a number of other companies also, high growth software companies, are now showing signs of life. Year-over-year quarterly growth rates are actually picking up. And I think this is largely due to AI being integrated in their offering, and more of their customers, using their AI workloads and benefiting from that. And also we have seen some margin improvement, as you pointed out, especially with vibe coding now. A lot of these companies are able to do a lot of the coding via AI as opposed to hiring more people. So that is also trickling through to the bottom line of these companies. So I think application software companies are more at risk. However, the deeply entrenched infrastructure software companies and cybersecurity companies seem to be pretty resilient from what's going on in the AI space. Let's dive in a bit deeper and bring in Ivan and basically go over NVIDIA's Q3 operating results because he's been tracking them pretty closely. So NVIDIA had its earnings call. Ivan, any main takeaways that you actually walked away from after listening to it?
Yeah, so the company had a good quarter. Revenues grew 62%, as mentioned, and they beat consensus. So this helped quell some of the fears around an AI bubble. Management also pushed back on the narrative that GPUs have very short lifespans. They pointed out that the A100s that were shipped 6 years ago are still running at full utilization today. And the reason this matters is because there's been accusations that hyperscalers have inflated their earnings by extending the accounting lifespan of their data centers to up to 6 years, as this lowers annual depreciation costs. So this comment by NVIDIA kind of justifies these accounting practices. However, they also mentioned something that was a bit contradictory to this. So Jensen talked a lot about power constraints, that data centers only have a fixed amount of power to work with, and therefore performance per watt is critical. And we've heard other CEOs talk about that power and data centers are the main bottlenecks, not GPUs. Now, given newer generations of GPUs are roughly 10 times more power efficient, and if power is now a bottleneck, you would logically think that there would be some acceleration in replacing older, inefficient GPUs. So this would start to then lower the lifespan of GPUs going forwards. So in my mind, unless data center capacity is solved, lifespans of these GPUs should actually start to come down some.
That makes sense. So Google launched Gemini 3 recently, and it had very good reviews. It was also trained on its own TPUs rather than NVIDIA's GPUs. What do you think the implication is here for NVIDIA, if any at all?
So it means NVIDIA might get some competition. This is still a big maybe, but we did recently hear reports about Meta potentially buying TPUs from Google, though this hasn't yet been confirmed. Also, we've seen companies like Tesla design their own chips. However, I do think that this competition risk is already somewhat baked into NVIDIA's share price.
Why do you say that? Why do you think it's priced in already?
Because if you look at their growth rate, which is projected to be around 50% next year, and then look at their PE ratio, NVIDIA is actually quite cheap. And the reason is that if they do get real competition, that doesn't only mean lower revenues, but it also means lower margins. Like right now, NVIDIA has gross margins of around 73%, which is only really sustainable while it essentially has monopoly status. So the total hit to profits would be quite substantial if they got real competition. Now, obviously, if this risk materializes in a meaningful way, then NVIDIA's share price will decline. But it also means there's a lot of upside in the price if it can hold on to its dominant market position.
So, and if NVIDIA was to lose its dominant market share position, which I don't personally see happening, what do you think would be the impact on the AI ecosystem?
So short term, you might get some negative AI sentiment because NVIDIA's share price would fall. But overall, it should actually be very good for other AI stocks, as healthy competition for chips means more choice and lower costs. So this means more of the economics from AI will be more evenly distributed within the ecosystem, which I think is a good thing personally.
Interesting stuff. I'll come over to you next, Anirban. Let's bring you in here. With TPUs running Google's AI stack and Meta reportedly looking to use millions of TPUs, plus Anthropic already with a deal for TPUs, do you think NVIDIA stops being the default choice for the biggest players maybe in 26, 27? And what does that actually do to the pace of AI?
Yeah, that's an interesting question, Puru. I mean, Avon's already touched on many of them, but I'm going to try to take a maybe a slightly different angle to this. I mean, obviously timing and, suggesting, trying to be the oracle here is hard, but, maybe 26, 27 actually indeed looks like could be the inflection point. I mean, I think, as you just said, NVIDIA has a huge moat, whether it's the CUDA moat or just the, its machines being generation ahead. I think when it comes to training of the frontier models, I think they retain the lead. It's just hard for them. Now, that doesn't mean that, Gemini 3 isn't a frontier model, but I think, the frontier labs will continue using them just because so many people just know how to use, CUDA, the Blackwell and the Rubin, these are, leading architectures. But I think where the flip happens is really with inference. And I think this could actually flip really quickly, and maybe we are already seeing signs of this in the market, right? There's, for example, in October, Anthropic, which basically has the Claude model, announced a deal with Google that they're going to use maybe, I think the number was up to 1 million TPUs. And this was, by the way, an expansion of their existing usage. And then, exactly as you guys talked about just, not too long ago, Meta is rumored to actually use Google's TPUs integrated actually into its own data centers. That would be actually very interesting. Instead of them running in the Google cloud, it'd actually be in the Meta cloud. And it is also planning to rent capacity. So that, I think, would change the game. And, I just don't think that Google is going to be the only one, right? I mean, there's AWS with its Trainium. Azure is doing similar stuff. And Apple is, working with, I think, something called Balta. It's going to run its own inference. So I think the key in my mind is if the shift happens, it really is good for tokens and token processing. And if that's the case, if most of the world's tokens are running on non-NVIDIA chips, right, then, I think to some extent the NVIDIA tax that everyone is paying disappears or starts to at least dissipate. And that basically means inference costs go down. If inference costs go down, I think that changes what you want to call it, maybe the physics or the chemistry of the industry, right? Because suddenly now it becomes really interesting to do application layer stuff, like things that we guys were talking about not too long ago. Software. You can do so many things with software, maybe, agents, enterprise co-pilots, whatever we want. These things should really take off. So in a way, we could see exponential increase in inference because token processing has become cheaper. So I think, in a way, I think NVIDIA stays, like a giant, but maybe its margin gets squeezed a bit. And honestly, I think, that might actually be a good thing for the overall health and, for like manifesting what AI can actually do. So I think, there's some interesting possibilities here.
Interesting stuff. Related question for you, Elias Sutskava, Jan LeCun, and others keep saying we're running out of high quality data and pure scaling is hitting diminishing returns fast. If compute suddenly gets a lot cheaper, right when the scaling hypothesis starts cracking, what does that actually do to the direction of AI research and the whole ecosystem in your view?
Yeah, again, this, maybe it's premature, but this looks almost like perfect timing, right? For years, the game has been, it's a very brute force game. And the brute force approach has been, I'm just going to throw more compute and more data to these bigger models. And these bigger models are just going to deliver better results. And it has been true for a long time. But we probably feel this already when we use the models today. You see that the delta change between the various model iterations are not that much, right? So maybe the era of just throwing more compute, you just throw more power at the problem and, you get better results. I think that changes. And if this era changes, then, most of the frontier models become more or less the same, and there's only finite amount of data, right? I think that's the other key point, right? You can throw more compute, but you only got finite amount of data. So if you combine this with cheaper inference, and maybe what let's call the above as capped, pre-training returns, that basically means that the marginal dollar has to go somewhere, right? It probably leaves, this let's build, trillion, 2 trillion, $10 trillion models, a parameter count, and it goes into other things, things like reasoning and test time compute. We've already started seeing that, right? So these models now, they actually think based on the question being asked. So sometimes they're using more compute, sometimes they're using less compute, right? That's an example of sort of innovation, but we should probably see a lot more innovation happen, new world models, potentially new, Jan LeCun, for example, has been saying for a long time that, what we are doing on LLMs is not the end, and there's going to be more stuff going to happen. More stuff is going to happen. Or more stuff is needed. And so that's new architectures, right? So I think there might be a shift to what I would call core AI research problems, solving those. And in a way, I think this is more like a leveling of the playing field, because all of a sudden you could have a $20-30 million startup team, crack and outmaneuver, a company that has, a $10 billion cluster. Yeah, because there's only so much you can get done by memorizing the internet, right? So I think you might see things like domain-specific models take off, and make economic sense. And I think, there might be a prestige shift. The best people want to, they want to go and work for Elon Musk because, hey, it's great to work for Elon Musk. He's got the biggest cluster. They want to go to work for OpenAI and things like that. But that might actually shift, So again, it's a prestige thing. People might want to work for these smaller companies that are actually solving core problems that actually moves the field forward. And, maybe the smaller models actually deliver that. So I think this is, again, overall, all of these things that we are seeing are great for the field. We might be moving from bigger is better to, the smarter is better kind of world. And, this is where business will finally see the real win. So I think, again, all of this, in my view, is good, and is good for the AI evolution.
Well, thank you. Ernest, I'll come to you next. You've been looking at the Neoclouds and the Hyperscalers pretty closely. In your view, how are the Neoclouds developing versus the big Hyperscalers? Why are they any better? Or you think, where is their niche in the industry?
Thanks, Puru. Let's just start with the very big picture. First of all, the Neoclouds are specialized. They're only focused on hosting computing that powers AI training and inference. They're a lot smaller, but they're growing way, way faster. And what they're trying to do is increasingly incorporate software to remain differentiated. And to just give some numbers to it, if we look at the big three hyperscalers, so that's Microsoft, Amazon, and Google, and you add up their related cloud revenues, it comes to a combined $280 billion. And it's currently growing at a blended rate of about 30%, so it's 20 to 40, and it's got an operating margin blended of about 30%. So that's about $80 billion of operating profit. Now let's look at the Neoclouds. If you take the top few of them and you add them up, it's roughly $10 billion of revenue. That's about 30 times smaller than the combined top three, the big three. And they're not really making an operating profit at the moment because they're still in that really, let's scale up mode. So it just gives you a perspective. But they're growing at about 100 to 200%, so doubling or tripling each year.
So, in terms of the Neoclouds, why are the Neoclouds emerging as a key player in the AI infrastructure landscape? What are the main benefits they offer to customers or clients, which the other hyperscalers don't, in your view?
Yeah, so, just quickly, they arose because of the major GPU scarcity we saw in 2022, 2023. They were small, nimble operators. They were able to get some allocation of GPUs from NVIDIA to build their little AI factories. And many of them came from being previously crypto miners and having a lot of GPUs involved in that, which they repurposed to AI. Now, I think what's important here is to look at what are the major pain points for customers in this space. The main ones are really long wait times for these GPUs and bloated pricing. So the big hyperscalers arguably sometimes overcharge for certain things. So what is it that these smaller, more nimble Neoclouds can bring to the customers? Well, it's really 3 or 4 things. The one is speed to market. So they can get the clients up and running very quickly. And that helps these small startups, these AI labs, helps them to just get online pretty quickly with all those models. The second is the cost savings. We're hearing things of 20 to 50% cheaper per compute unit, if you want to call it. And the reason is that they focused on AI, and they can pass all those bulk deals that they get with NVIDIA onto their customers. Then you've got customization. And this is very important because when a company goes to an Amazon AWS and says, can you do it a little bit differently for me? They say no, because we've got a massive sort of business globally with 30 regions. We can't roll out something slightly differently for you, but the Neoclouds can. So they're very agile, and they can even focus on particular AI frameworks for the customers. So it's really those three factors which they bring a lot of benefits to the smaller clients and to the bigger ones.
So how are the Neoclouds adapting to challenges such as GPU lifespan concerns and power efficiency?
Yeah, so this is an important one which I think Oyvind touched on earlier about GPU lifespan. There is a concern in the industry, and I think where it's coming from is that at the heart, NVIDIA started accelerating their cadence for rolling out these chips, rolling out newer chips more frequently. And I think what the Neoclouds are doing in combination with this challenge on power efficiency is they're trying to use these two headwinds as an advantage. So what they're doing with GPU lives is they're focusing on making their product or their offering hot swappable. So a client can bring in a new Blackwell chip, for example, swap it out, put that one in, but not change the overall sort of system. So they can preserve some of those asset lives. So that's what they're doing. Then in terms of the power efficiency, what's very interesting is that the power draw of these chips is getting higher and higher. So yes, the power efficiency is getting better. So power per token, I guess, is dropping. But the absolute power is growing. So an NVIDIA H100 GPU is consuming 700 watts. And we're seeing forecasts that data centers will use about 8% of the world's electricity by 2030. So it's quite a significant portion of overall electricity. And what these Neoclouds are doing is they spearheading all the latest sort of liquid-cooled type topologies with NVIDIA as a partner to make it better and better from an energy point of view. They're also tapping into subsidies that governments are offering to make their data centers even more power efficient. So, that's what they're doing, and arguably they're at the leading edge of power efficiency. And then the final point is that they are putting in all these additional software pieces to make what they're offering better. So, for example, one of them is doing orchestration tools that basically allocate power across different workloads so that the GPUs don't sit idle, because if the GPUs sit idle, that's wasted power. So they're doing that. They're also giving green pledges, which is very important today because we're seeing all these big impact investors that are focused on ESG and sustainability looking for data centers that are doing it in a green way, so that the power that's coming into those data centers is coming from green sources and not from carbon-based sources. So this is what these players are doing, and that's how they are trying to remain at the edge. But it's really challenging for them because they've got to keep up with this.
Interesting stuff. I'm going to ask you one more question before I move on to Damia. How are the Neoclouds positioned versus the big hyperscalers from an investment perspective, in your view?
Yeah, I mean, the bottom line here, Puru, is that these Neoclouds have much, much higher growth. So arguably, if they can continue with this growth, there's potentially way better returns. The other aspect about it is that they are pure plays. So if you want to invest in this space specifically, that's the only way you can do it. When you buy Amazon, you're getting a monstrous retail business. When you buy Google, you're getting a huge advertising business, way bigger than the cloud and the AI business. When you buy Microsoft, you're getting a massive, horizontal software business that's global. Whereas if you just want focus on this space, you can get it with these Neoclouds. But there is one problem here, and that is with that high growth and their size and the way they are structured, there's a lot more risk too. And I think the main 2 or 3 that I'll put on the table here is execution risk. I mean, this is really difficult to roll out. And secondly, they've got big debt loads. So yes, their debt is tied to contracts, but there's still huge debt, and one's got to look at that. And then there's the uncertainty of the lifespan of these GPUs, which remains to be seen, and we will see it unfold as we go.
Thanks, Ernest. I'll move on to Damia next. Damia, you've been watching the payment space, the buy now, pay later space pretty closely. The Fed has ended its QT tightening cycle, or it will end it on the 1st of December, and has been cutting interest rates, possibly with more cuts coming in the next few months. How is this shift to lower interest rates affecting buy now, pay later players like Klarna, for example?
Of course. So low interest rates can ease the borrowing costs for BNPL companies as they rely on affordable capital to fund loans to consumers. So lower interest rates are generally good for these BNPL players like Klarna. But there's a real concern coming from the broader economic picture. Recent jobs data is signaling that things are slowing down, which means consumers may pull back on spending and take on fewer loans, as Anirban has mentioned previously. So if people are losing jobs, the defaults on existing loans could also start to creep up. There was also a concern that the Fed may cut rates at a slower pace than expected. So this may keep borrowing costs high for these players. All of that adds up pressure and therefore could affect Klarna's financial health moving forward. So when you look at Klarna's share price, its stock has actually gone down by 40% since the IPO. So the stock seems to be pricing in the macroeconomic risk that's been happening lately.
Recently, Klarna reported its first quarterly earnings results post-IPO for Q3 25. How did the company perform, and did they give any indication of what things may look like for the sector going forward?
Even though the stock has been going down, but they actually had a standout quarter. It posted record results in Q3 of 2025, with revenue reaching 903 million, that's 26% growth on a like-for-like basis, driven by a massive 51% jump in the US and 28% growth globally. GMV also moved higher, up 23% to $33 billion, with strong performances across US, Southern Europe, and Sweden. Its take rate improved to 2.76%, helped by growth in the US and also continued expansion of its fair financing offering. This lets customers to break up larger purchases into longer-term monthly installments at competitive interest rates. Their credit quality is also holding up well. Realized loss as a share of GMV came in at 0.44%, slightly better than last year. And their fair financing delinquencies actually fell 5% year on year. So their credit losses provision increased to reflect how quickly that portfolio is scaling. Generally, they're still seeing strong results and also are guiding strong outlook going into 2026.
Were there any weak spots in the results that caught your attention?
So the main weak spot is their quarterly their profitability in the quarter. So Klarna's net loss widened to about $95 million in Q3 of 2025. This is compared with $4 million loss last year. Management explained that this is mainly because of the rapid expansion of their fair financing portfolio and the timing of its plan to offload part of that portfolio. So they emphasized that this drag should be temporary and is expected to expect the impact on profitability to start easing as soon as the next quarter.
What multiples are you using for Klarna to value the company, Lamia? And do you think the company is fairly valued at today's valuation?
So given that Klarna is still a new listed company in the early stages of scaling and hasn't yet reached non-GAAP profitability, so I think looking at the next 12-month price to sales multiples makes more sense for now. The stock trades at about 1.4 times, which is below its post-listing average of 2.2 times. From a valuation standpoint, that does make the share looks relatively inexpensive. As we move into a period of lower interest rates, that's generally a tailwind for companies like Klarna because cheaper borrowing costs can support their profitability. But for BNPL players to truly benefit, the broader economy still needs to hold up. A resilient backdrop encourages consumers to spend and keep demand strong for BNPL products.
Yeah, I agree with you. I think, if you look at the BNPL space as a whole, we are seeing some signs of stress, but by and large, the industry is still, doing pretty well. Obviously, this will become a bigger concern if and when the US economy tips over into a recession. That's when you see the real stress emerge for these payments and these companies which rely on borrowing, consumer borrowing. But I think for the next few quarters, I think the outlook looks pretty decent. We've invested in, a business which is actually at the forefront of this industry. We generally like to stick with the leaders in the space, and the delinquencies aren't really spiking up and everything else. So for now, I think these businesses are still pretty good, and I think the industry itself is still pretty early in its life cycle. It still represents a very tiny percentage of the total payment space, and I think over the next 5, 7, 10 years, BNPL, buy now pay later, will actually proliferate and take more and more share from credit cards and so forth. So it'll be interesting to see how it plays out. I think we've covered a lot of ground today in our show. So this brings us to the end for today's episode, and we hope you enjoyed the discussion. Before we leave, we just want to mention that AlphaTarget publishes deep research on disruptive, rapidly growing companies in the public markets. If you'd like to learn more about our research subscription, please visit alphatarget.com. Thank you very much for tuning in, and see you again in a couple of weeks.
Thank you for tuning in to AlphaTarget Pulse. We publish deep research on disruptive, rapidly growing companies we invest in. Our subscribers gain exclusive access to our entire portfolio, including exact portfolio allocations, in-depth research, coverage of companies' news flow, and our earnings breakdowns, trading alerts of our portfolio moves, and our proprietary hedging indicators. You can find subscription information at alphatarget.com. We'd love to have you join us there.